In this video we are going to talk about dividend stocks to buy and hold forever. So before starting this video, please like this video and subscribe to this channel for our future updates. Search keywords such as stocks to buy now or top stocks to invest in are used by hundreds of thousands of individuals every day. The reality is that investing is difficult, and establishing a portfolio of top stocks to buy that outperform the market is something that even financial specialists have difficulty achieving on a continuous basis. According to the S&P Wink with tongue sticking out 500, only around 15% of actively managed funds outperform the index over any extended period of time after costs are deducted. Brookfield Asset Management, BAM. Brookfield Asset Management, BAM, is a Canadian financial services company that you may not be familiar with. An asset management company focused on the management of the real estate, infrastructure, and renewable energy assets is described as follows. Their origins may be traced back more than a century when the corporation was a pioneer in the development and operation of key infrastructure in Brazil. Over the past 2 decades, they have grown into a worldwide asset manager with assets under management totaling more than $500 billion. They own a vast range of properties including gas pipelines, toll highways, data centers, solar farms, hydroelectric dams, and skyscrapers, spread over 5 continents and a variety of industries. In their capacity as a private equity business, Brookfield Property Partners, BPY, Brookfield Renewable Partners, BEP, Brookfield Infrastructure Partners, BIP, and Brookfield Business Partners, BBU, make money in 3 main methods. First and foremost, they put their own money into a range of real estate holdings. Second, they raise money from institutional investors, invest that money on their behalf in a variety of real estate assets, and then receive performance fees from that money. Second and third, they formed and own significant shares in the publicly traded partnerships, from which they get cash distributions, management fees, and performance fees, collectively known as incentive distribution rights. Enbridge Inc ENB. One of the major midstream corporations in North America, Enbridge is a leading provider of energy and natural gas. A massive pipeline network is maintained by them, and this network distributes oil and natural gas from where it is gathered to where it is needed to keep Canada and the United States powered and warm. Despite the fact that there have been a few instances, pipelines are both safer and more cost-effective for transferring energy than the primary alternative, which is the railroad freight car. Enbridge has almost no direct exposure to commodities prices. The company's primary source of revenue is the transportation of energy. Extended periods of low energy prices, on the other hand, have the potential to reduce oil and gas production volumes, resulting in fewer volumes and reduced revenues for oil and gas transporters such as Enbridge. One of the aspects of Enbridge that we admire the most is their significant natural gas exposure, which is in addition to their oil exposure. Oil volumes are under danger from electric vehicles in the long run, and it is difficult to forecast how long this will take, but natural gas is expected to remain an important source of energy for decades to come. Even though renewable energy is expected to capture a growing and larger part of new energy projects, natural gas is expected to steal market share away from coal in the near future. Comparatively, natural gas emits significantly less carbon dioxide and produces significantly lower quantities of toxic pollutants such as mercury, as compared to coal. Apart from that, Enbridge has a limited portfolio of renewable energy assets, which it intends to expand over time. A number of acquisitions and consolidations have been completed by the corporation in recent years to streamline its business strategy. To be more specific, they acquired Spectra Energy, which provided them with a significant increase in natural gas exposure, and then purchased out other master limited partnerships in which they had significant shares, putting all of this under the control of the parent firm. Alphabet. Alphabet currently boasts what is likely the greatest financial sheet of any corporation in the world, with over $132 billion in cash equivalents and only $14 billion in debt, according to some estimates. Furthermore, they are continuing to develop their income and profitability at a rapid pace. This style of chart is referred to as an FAST graph, and it depicts the relationship between stock price and fundamentals. With respect to the stock price, the black line represents its current value, The blue line represents what it would be worth at any given time if it were trading at its average price/earnings ratio on that year's earnings, which includes 2 years of consensus analyst forward estimates. Besides operating the Google website and YouTube, Alphabet also operates numerous other platforms, such as Android, Google AdSense for other websites, Google Maps, Google Cloud, and so on. Alphabet is the parent company of Google. They also have some of the most cutting-edge technology in autonomous technology, and they are among the top researchers in the field of quantum computation. HDFC Bank HDB. HDFC Bank is the largest private bank in India and is headquartered in Mumbai. It is celebrating its 25th anniversary since its inception in 1994, and it currently has over 5,000 outlets as well as a thriving internet company across India. India is on track to surpass China as the world's most populous country, despite the fact that the country's per capita GDP is still quite low, but rising. In addition to being a huge emerging market, it has one of the world's fastest GDP growth rates and is expected to overtake the United States as the world's largest economy by the 2030s. In addition to the usual risks associated with running a bank, HDFC Bank stock is subject to 2 significant hazards. First and foremost, it is pricey, with a current blended price-to-earnings ratio of more than 30. As a result of its profits growth of approximately 20% each year, the company's PEG ratio, which was coined by Peter Lynch and compares the valuation of a company to its growth rate, is rather favorable for investors. Second, India is heavily reliant on oil imports, and anytime oil prices rise, the country's trade deficit expands, which has a negative impact on the currency's value. Etochu Corporation Etochu. Japan is home to a number of significant trading companies that are involved in a variety of activities such as sourcing commodities, providing logistics services, and operating numerous enterprises. Etochu Corporation, for example, has been one of the most successful of these companies. For investors in the United States, it is available for purchase on the OTC market as an ADR under the ticker ITC, or it can be purchased on the Tokyo Stock Exchange. JDcom JD. Some believe JD to be one of the Amazons of China, and this is a fair assessment. They're a huge e-commerce corporation that has spent the last decade constructing a massive set of logistical infrastructure across China in order to provide speedy delivery to customers. Unlike Alibaba, JD controls the vast majority of its own sales, which cuts margins, but allows them to exert greater control over product quality and safety. Their revenue growth has continued to spread like wildfire, and their valuation is significantly lower than it was at the beginning of the year. Quarterly revenue is represented by the purple line in the chart, and the price/sales ratio is represented by the orange line. Discover Financial Services (DFS). Discover Financial Services, which was split off from Morgan Stanley in 2007, currently operates a lean online bank as well as 2 important payment networks, according to the company's website. Along with Visa, MasterCard, and American Express, the business also owns the well-known Discover brand, which operates as one of the 4 major credit card networks in the United States. Since its inception a decade ago, Discover has grown to include an online bank with a varied range of products and services that include checking accounts, savings accounts, personal loans, student loans, and home equity loans to individuals with excellent credit scores. They also hold the Pulse Payment Network, an interbank electronic payments transfer network, and Diners Club International, both of which are publicly traded companies in the United States, a charge card brand. In the United States, Discover is widely recognized, although it is not nearly as widely accepted abroad as Visa, MasterCard, and American Express are. This is a disadvantage for obvious reasons, but it also represents a source of future growth for the company if they are able to expand abroad in the same way that the other 3 major card networks have done so. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.